Ladies and gentlemen, good day and welcome to Puravankara Limited Q1 FY23 earnings conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Samar Sarda from Axis Capital Limited. Thank you, and over to you, Mr. Sarda.
Thanks, Nirav. Welcome again for the results call for Puravankara Limited. Thanks for taking time out. From the management, we have Mr. Abhishek Kapoor, the ED and the CEO of the company. We also have Vishnu Murthy, who's heading Risk and Control, and Neeraj Gautam, Executive Vice President of Finance. Can I request Neeraj to start with his initial comments, post which we can open the floor for Q&A.
Thank you, Samar. Good afternoon, everybody. Thank you for joining us at Puravankara Limited's first quarter of FY23 earnings conference call. My name is Neeraj Gautam. I am the Executive Vice President Finance of Puravankara Limited. The presentation and financial results for the quarter ended June 30th, 2022 have been uploaded on the stock exchanges. I presume you have all had a chance to go through the results and detailed presentation disseminated by us. I will like to take you all through the key highlights for the quarter. Following that, my colleagues and I will be happy to answer any questions you may have while listening to feedback and suggestions from you. We believe real estate will continue to witness sustained growth this year and coming years in our country. The latest increase in home loans, interest rates, and global economic environment will have very little impact on housing demand in our country. We have started the financial year on a very good note. We are delighted to say that the company has achieved its highest ever sales in the first quarter of any financial year. And this is remarkable as it has been achieved in an interesting environment without any new launches. We have registered the highest ever first quarter sales this quarter, reinforcing the team's dedication backed by sound leadership and the pillars of quality, trust and customer experience that Puravankara brings to the table. The quarter sales touched INR 513 crore, riding on the favorable market sentiment and rising home ownership aspirations. The entire sales were achieved from booking of inventory on ongoing projects. The sales volume during Q1 FY23 stood at 0.69 million square feet, up by 64% year-on-year basis. As a result, sales value during Q1 FY23 jumped by 63% to INR 513 crore compared to INR 314 crore in the first quarter of the previous financial year. Coming to the profit and loss account for the quarter, our consolidated revenue for Q1 FY23 was INR 297 crore. EBITDA for the quarter was INR 139 crore, implying an EBITDA margin of 47%. During the quarter, we achieved a profit after tax of INR 35 crore, implying a PAT margin of 12%. We have continued to maintain sustainable levels of debt during the quarter. Our net debt was 1,889 crore. We have maintained similar debt levels for the last 1 year, ensuring that we are optimally leveraged to fast-track our growth while keeping our feet on the ground. As on 30th June 2022, our average cost of debt was 10.69%. Coming to the cash flow management for the quarter, our operating inflows for the quarter Q1 FY23 was 667 crore, up by 16% from INR 525 crore in Q4 FY2022. As on June 2022, the balance collection from sold units in all launch projects stood at 2,550 crores. The balance cost to be incurred stood at INR 2,849 crore. Combined with the unsold receivables of INR 4,394 crores from launch projects, the projected operating surplus of 4,095 crore on the launch portfolio compares very favorably against the current outstanding net debt of INR 1,089 crore. Besides this, we have also not open for sale inventory, from which we have an estimated surplus of 2,036 crores. The Indian economy is showing stability and resilience, and we are bullish on it. The government's focus on infrastructure, including airports, roads, and rail networks, will give impetus to the growth in our country and create employment, and that will result in further demand of home in our country. We are upbeat about our new launches and will continue to focus on scaling our operations while maintaining a healthy balance sheet. As a customer-centric entity, our primary focus will be to offer our customers high-quality products and seamless home buying experience. Our budget and expenses control measures have put us in a solid position to optimize buying sentiment. We remain confident in creating sustained value for all shareholders by delivering growth and margin expansion through optimal capital utilization. With this, I conclude my remarks. Thank you for joining the conference call. Now we are open for questions that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Aryan Sharma from Infinity Capital. Please go ahead.
Yeah, good afternoon, sir, and congratulations on the good result. My question is regarding the land parcels. You already have a good presence in South India. Are you also looking towards some more land parcels in other parts of the country, or will you focus on these areas? And if yes, by when it will happen, and what could be the size of these land parcels?
Hi Aryan, thank you for the question. While we have the current land bank of almost about 54 million square foot, which is spread across south and west, our growth is further growth, which is increased acquisition activity is happening in majorly 5 markets, which is Bangalore, Chennai, Hyderabad, Mumbai and Pune. And these are the markets where we want to go deeper. For the rest of the market, it is more opportunistic because we have been in these markets, which are, like Kochi, Coimbatore, Goa, Mangalore. These are markets that we have always been present in, and we look at it more opportunistically if there is, because we have a strength and we understand the local environment. We have delivered multiple projects, so that enables us, gives us that that confidence to continue in these markets. But growth will come from these markets, the other markets. From the size of the land parcel, see, our strategy is quite clear in terms of the acquisition plan. Now, that is largely spread between Puravankara, commercial, residential, Provident and Purva land. Purva land, typical size of transactions would be anywhere between 50 to 100 acres because that's the kind of plotted development we look at. Wherein we need because the kind of volumes we are able to do and sales that we are able to achieve in the plotted development gives us that flexibility and comfort. As far as Provident is concerned, we look at least 1 million square foot of sellable area to start with. So if you look at my realization, a top line of at least 650-700 crores would definitely be something that will be required, because that is the attention we need to pay to the project, and it should be worthwhile the time of the management. So that's the minimum size. Of course, we have done 2 million, 3 million, 6 million square foot larger projects in Provident, and because it also requires a certain scale of operations to drive efficiencies, being affordable housing. As far as Puravankara is concerned, again, we look at a minimum top line of say 700 to 1,000 crore, and that could range in different markets from anywhere between 500,000 square foot going up to 1.5 million, or even larger, depending again on the location in the market. So that's a general tendency. But most of our acquisition is in the sweet spot of say about 1 million square foot to 2.5 million square foot, which gives us a lot of comfort and visibility on financial closure of these projects within a time frame of 5 to 6 years. So that's generally the area of focus, and that's how we go about our acquisition.
Okay, got it. So my next question is regarding the Starworth Infrastructure and Construction Limited, that is the SICL. Can you throw some light on what kind of revenue we are clocking over there, and what are the margins? And also what sort of market we are targeting, and the growth, say, in the next 3 to 5 years?
Right. So Starworth is an organization which, we have recently done some additions in the leadership team. Let me just introduce that a little bit for you. So on the management, we've added a COO from Katera, and who specializes in precast. We added Satyanarayan from Tata Projects. He was ex-CEO for Tata Projects. He's handled a very large book. The business per se is really focused on two key areas. One is, of course, precast, and two is buildings and special projects, which is the third one. So in buildings, when we say, we count commercial, we count data centers, we count residential. That is the general setup. And third, of course, as I mentioned, is special projects, which is because it is a EPC business, and we are building the entire EPC strength over there. We already have it actually. So let me give you an example of the kind of projects that we're looking at. So for example, we are executing the Bangalore metro stations, about 23 metro stations. We are executing Taj at the Bangalore International Airport. We have taken just recently another contract with Taj EVK. We are doing a very interesting, one of the largest pours ever we have done, or we are now going to do, which is in blast furnace we are doing for Jindal Steel. So special projects like Jindal Steel or Metro, etc. ICC is another, client that we have recently added to our portfolio. So the idea is to look at grade A clients and add. So today, for example, a larger portion, almost 60-65% of the business comes from Puravankara, and about 35 is outside. We want to exactly reverse it. In fact, we want 80-90% of the business to come from outside, and that's where the entire focus is for Starwood, because we believe that there is a opportunity for a mid-sized player in the contracting space. Coming to your question on margins, you're typically looking at a margin of a net margin of somewhere between 8 to 10% for a contracting company, and that's what we work towards, net of overheads. So that's the plan. From the growth point of view, last year we did very well, but it was on a very small base that the business grew. This year again we are targeting an aggressive number, a growth number.
500 crore kind of turnover.
Yeah.
Turnover from that company.
Yeah. So that's the target. Let us see how that pans out. But the billing looks good. The business looking good. Acquisition pipeline is looking healthy. So we're quite optimistic about where we headed with this business.
So what is the number?
This quarter we recognized 89 crore revenue in that company. SI sales turnover for the quarter was 89 crore. And a profit was about 2 crore net PAT for the quarter. So and yearly, as Abhishek mentioned, we are targeting sort of 500 crore revenue from that company in this entire financial year.
Okay. Thank you for the detailed answer. And lastly, coming to the order book, like we are saying, the order book is more than 1,000 crores for quite some time now. So what is the current size, and what would be the year-over-year growth in the orders?
So as we mentioned, because we just strengthened the team, and it's been in last 4, 5 months, 6 months. In fact, the focus first has been to strengthen the systems, processes, the organization itself, and start speed up our current execution, which is why you're seeing the existing revenue booking. At the same time, you're looking at new acquisitions. So I think by the end of this year, I think the order book will improve. With the way the pipeline is looking, we'll have to wait and watch and see where we land up with it. But our goals are quite aggressive. Excuse me.
So noted. Thank you. That's all from my side, and all the best.
Thank you.
Thank you. Participants, you may press star and 1 to ask the question. The next question is from the line of Ashutosh Mittal from Axis Capital. Please go ahead. Ashutosh, may I request you to unmute your line from your side and go ahead with the question, please? Ashutosh, we are unable to hear you. May I request you to unmute your line from your side and go ahead with the question, please? Due to no response, we move on to the next participant. The next question is from the line of Nikita Gupta from LKP Securities. Please go ahead.
Good afternoon, sir. Thank you so much for the opportunity. I just had a couple of questions on the Purva Asset Management front. Just wanted to know, since you launched your first AIF fund in April, Have you been able to raise some money as of now, and when do we expect to raise the marked 750 crores, assuming the green shoe option is exercised? First on that. And how is the revenue sharing agreement going to work? Can you throw some light on that as well?
Right. Thanks, Nikita, for the question. The answer is yes. We have been able to do the first close, which was targeted at about a little over 200 crores. That has already been done. Now we are in the process of additional the further capital, which is also lining up, and we will hear soon about the next round of closure. The second piece is on how do we see the revenue shared with the fund. So basically, the way we look at this entire structure, the fund structure, is that the fund essentially is participating in the land, which is where maximum value is, and the acquisition is happening from the capital from the fund. And the development is done by Puravankara. So therefore, the revenue share has to be in a manner which is targeted to achieve a mid-20s, early to mid-20s kind of return for the investors in the fund. And of course, the process is there. There is a process of evaluation and objective validation of third-party validation of the numbers, so that there is complete transparency. There is an advisory board in place for the guidance. So the whole idea is to keep it objective and ensure. In fact, this is something that we believe personally that will be a significant line of capital going forward from equity point of view, which will give us great amount of strength. So we want to really ensure that the deployment of capital is done in a manner which ensures not just the security of capital, but the returns that we have, which we have promised from the fund. So we're quite optimistic with this, and we'll start hearing soon about the deployment of the capital which is already raised.
All right. Thank you so much. That's all from my side. I'll join the queue for more. Thank you so much.
Thank you.
Thank you. Participants, you may press star and 1 to ask the question. Next question is from the line of Dikshit Mittal from LIC Mutual Fund. Please go ahead.
Hi, good afternoon, sir. So my question is on new launches. So though you have maintained the pipeline of around 15-60 million square feet, but during this quarter there was no new launching. Particular reason for that?
No, really, there is no reason except that we are in the final leg of. Some of them are in RERA registration, some are at the final leg of approvals, and so that is the only thing. There is no other reason per se. So we are pretty much on track. We are pushing hard on these launches. So I think you'll start hearing it from this quarter itself.
Okay, because sir, in your last presentation you had mentioned 1 million to be launched in this quarter itself. So that's why I was asking, is there any approval related delays or anything like that?
Yeah, so there is marginal delay because these were expected anyways towards the end of the first quarter, which is spilled over. So I think in the second quarter we'll see these launches.
Okay, so full year, what is the kind of number that you're looking at in terms of new launches?
So in the next 12 months time frame, we are looking at total, as I mentioned earlier. The target is actually by the March of this financial year to launch 16 million square foot. As I mentioned, Puravankara is about 6 million square foot, Providence is another 6, and then 4 is Purva land.
Okay. And sir, in terms of target completion for this year, what is the target?
So this year, in fact, we have set ourselves up to deliver about 3,000 homes, and a lot of that delivery also. So if you look at our numbers, operating cash flows have also gone up. Cash outflows, which is basically our burn, has gone up significantly. It's gone up by about 77%. So we are obviously really focused. So that's really picked up very well. Today we have over 5,200 laborers on our sites. And it's only increasing by the day. So there is a lot of delivery planned in this year. 3,000 units minimum we should be able to achieve. That's the target we have set for ourselves. But most of it will possibly start coming from the third and the fourth quarter.
Okay. So in terms of square foot, can you give some any guidance?
I'm sorry, I missed that.
In terms of a million square foot, how many million square foot will be delivered or maybe completed this year?
You can safely assume about 3 million square foot. I mean, typically about 1,000 square foot average you can assume, and we should deliver about 3 million square foot this year.
Okay, but it will be back-ended, right? Because first quarter it's only 0.1.
I mean, it's all under construction because at the time when we hit the COVID and then the delays and all of that, so a lot of spillover happened. And last year also there was some extent of disruption. So I think now that is all streamlined, we should start seeing delivery in the third and fourth quarter.
So lastly, what are the collection figure for the first quarter?
Its total operating cash flows were
686 crore.
686 crore. Okay.
If you look at our presentation on slide 15, 667 crore to be precise, the whole operating inflow for the quarter. That includes, just for clarification, that includes about 450 crore from projects, for other businesses about 100 crore, and the remaining from some small other income.
Okay. And then lastly, what is the component of other income in the total that is reported in total sales? 82 crores of other income.
So other income is, see, in our business, other income is also related to, these are other operating income. It's not other income from investment or interest or these interest or transfer charges, very small, about 10 crore. Rest of our income is from business operations, either from sale of the project or exit from one of the assets here and there. During the last quarter, entire income barring 10 crore is the transfer charges, interest, and those transfer charges are also related to operation itself. If somebody is, or we charge late interest fee from one of the customer, all that includes in other income. During the quarter, besides the project collections, we have also collected about 112 crore from one of the commercial property exit.
Okay. And so lastly, for the full year in terms of pre-sales, so any targets that you're working with?
Sorry?
So for the full year in terms of pre-sales, any targets that you have in mind for FY23?
No, we don't really give any forward-looking statements, but yes, I mean, we have given you a certain set of area and new launches, and you can compare with what we have done in the last year. Area sold was about 3.5 million square foot, and we believe that and 2,400 crores. Now, if you look at our number in the first quarter itself versus the 300 odd crores, we are already at 513 crores, right? So you can do the math, but yeah, it's looking good so far. And this is only from sustenance without adding new launches. So I think we will have to wait and watch and see how the company performs. But yes, internally we have fairly aggressive targets.
Okay, because the last 3 quarters you are maintaining around 1 million square feet on an average. So this quarter we have seen a dip on that front. So that's why I'm asking, can we go back to 1.2 million average for the full year of 4 to 5 million square feet?
See, let me answer it the other way around. Last year in the same quarter, see, this is normally April, May, June is our weakest quarter every year, and that's across the industry more or less, generally, unless you add new launches. But all of this sales has come from sustenance, and within sustenance we have been able to do increase our square footage, and we have gone to almost 0.7 lakh square foot, which is 0.7 million square foot. So I think we see that trend only going forward with the addition of new launches going up.
Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Ashutosh Mittal from Axis Capital Limited. Please go ahead.
Good afternoon, everyone. So now that you are present in 6 big markets, what is the medium-term sales per market that you are targeting? If you can quantify the same.
So, over time, let me break it down first business-wise. So we are looking at about 35% of our business from Puravankara, 35% from Provident, about 20% coming from Purva Land, about 10% from commercial. That's the general breakup of the categories we are present in and the brands. Now, if you look at geography, today majority of our business comes from the south, and a very large portion of this is coming from Bangalore. for some more time, because of our land banking and because of our current availability of lands which are already in the portfolio and paid for, is from the same region, and of course the largest portion of the south is in Bangalore, which is good news for us. Having said that, I think going forward there is clearly a target that west is going to grow quite a bit, and while south will continue to do the square footage that is doing and add to it, west will add disproportionate square footage, because we've entered that market and we believe that there is a huge opportunity for us over the next 5 years. So as we go along, I think in terms of value terms, if I look at 2 to 3 years time frame, in next 3 years we would expect sales of at least 25-30% from the west, and then take it possibly even up to 40 to 50% at some point in time in terms of value. In terms of square footage, we will always continue to see south as being very, very dominant, because values are lower compared to the west, specifically Mumbai market.
Okay, so talking about Mumbai specifically, so you have hired senior industry resources for expansion there. So what does the BD pipeline in Mumbai look like currently, if you can put some light on it?
So BD pipeline looks fantastic across the board, not just west and south. We're really focusing on it. A lot of term sheets, MOUs are in process right now. Due diligence and documentation is being discussed. So obviously, as I mentioned, there will be a lot more value expected from the western market. So therefore, you will see disproportionate, kind of acquisition happening from the western market.
And there would be more of outright or JDA agreements?
A mix of both. It's a healthy mix of both. Obviously, outright purchases has its own advantage in terms of value and the margins, and then JDA of course allows you to do volumes, and it's an asset-light model, so it will be a mix of both.
Okay, and is there any specific amount that has been set aside or decided for new project tie-ups in west as well as in south? If you can quantify that number.
See, if you look at it from acquisition point of view, over the next few years, the kind of capital raise we are talking about 750 crores coming from the AIF itself, and then we are in discussions for multiple platforms for our residential commercial space, right? And in fact, IFC is also on board on the affordable housing side. So between all of this, we would estimate that we will be able to raise and deploy about, a target is about anywhere between 2,500 to 3,000 crores over next, 2 to 3 years time frame.
Got it. And the last question from my end. So gross and net debt have been relatively stable over the period. So with number of projects and sales increasing, how will it trend over the next 18 or 24 months?
Look, I think, a lot of our business, and I'm sure, you understand this possibly even better, you work across industries as well. Your overhead and multiple fixed costs get only reduced as you do the volumes, right? So it is for us very, very important that we have the bandwidth. We have in fact added the bandwidth to be able to do more and more volumes. So overall basis, I think we will definitely maintain or improve our margins as we go along and we do more number of projects and more number of launches.
And as far as debt is concerned, we maintain this kind of debt for last 1 year. However, kindly note that we are in growth phase and we have leverage to take opportunity in the market.
I think what we should look at from the debt point of view, sorry I missed that question maybe, is that we look at it from the per square foot basis. So how much square footage do you have on the floor? And I think there is a healthy way of looking at it. And is your debt backed by project cash flows? Is it CF? What are you looking at with the debt piece? How is that debt going to help you unlock your equity, which is there in this 50 million square foot? So we look at it in that context. I think we are in a very healthy position. We have maintained the current levels. On a per square foot basis, as we go about with the launches, I think overall you will see the reduction in the debt on per square foot. In absolute number, I think that is dependent on the quantum of business that we put out on the floor.
Yeah, thank you. That was it from my end.
Thank you. But next question is from the line of Pritesh Seth from Motilal Oswal. Please go ahead.
Hi. Thanks for taking my question. Sorry, I joined a bit late. So one question on the cash flows. I see a reversal amount in the investment by IFC. If you can explain what is that?
Good that you have asked this question. It's not a reversal. We have repaid the IFC investment of 68 crore from the project collections. Rather, we have paid 100 crore, 68 crore the principal repayment to IFC. As you are aware, as will be updated to all the shareholders and the analyst community, that IFC had invested in the two of our projects. In one project, we have repaid them about 100 crore during the quarter from the project receivables, and we have fully repaid them in the month of July.
Okay. And so what is the balance amount? I mean, in terms of how much you have paid in July additionally?
We have paid about 200 crore. 200 crore we given when complete exit to them from the project. They invested about 157 crore in that project, and we have given a full exit for 200 crore.
Oh, awesome. And what was the time frame when they entered into this project and
entered into December 2020, the first investment, and the final investment in March 2021, and we are given full exit in July 2022.
Awesome. Great. And secondly, while we are in the last question you answered about your internal capability being increased. Firstly, I missed that slide where you generally give your details about currently ongoing projects. What's the size? So maybe if you can add it next time, that's very helpful for us to understand how the business is scaling up. And secondly, since we have over the last 2 years invested a lot in terms of manpower, where the organization capability is going ahead in the future, like historically we have built 24 million square feet of ongoing projects at a given point. Where do you see that increasing in future, since we have invested in capabilities in the last 2 years?
So, good question. I think from the way we are looking at using this leadership strength, and the whole idea is of the P&L structure is to really focus, and you're right, on the delivery of the projects. Now, if we were to look at our portfolio of total land bank that's available, which is in excess of 50 million square foot, and we are talking about 16 million square foot taking to market this year, then obviously our expectation is that this 3 to 3.5 million square foot should scale up minimum to 5 to 6 million square foot over next few years, right? But from the time I launch to the time we start delivering, there is the projects go under construction, but the delivery has to pick up only when the project completes, which is a life cycle you can assume of anywhere between 3 to 4 years. So real deliveries you will start seeing in 3 to 4 years in terms of delivery and revenue booking. But if you look at, I think what we should really watch for is our sales numbers annually and the cash flows, I think, and the burn rate. If you look at these three numbers and that continues to remain, in the growth direction the way we are planning, I think that should give a lot of comfort. And more or less your overheads get, with this entire scale up and strengthening that we have done, we should be able to bring in a lot of efficiency there.
Right. Just a follow-up on that. So, the 24 million square feet of ongoing projects that we have been doing, that should obviously go to 30, 35 to see continuous growth in sales number. Is it the right way to look at it?
What Mr. Abhishek said, I just would like to add to it. See, right now what we have been managing over the period of time, you can see 22 million square feet. By adding the leadership team, we also, bifurcated the P&L in the businesses. Like he said during the conversation, the PHL is another business vertical, Purva Land is another business vertical, and Puravankara is another business vertical. All put together, if you can look at the project which is currently doing, which is ongoing, plus the launch pipeline. So everything is about to come for the overall business volume for the company.
Right, got it.
Clarify then that if you look at the current projects under operation, plus the pipeline for launches, this entire pipeline plus the existing project will be managed by the entire leadership team.
Yes. Okay, got it. And sorry, just a follow-up on that IFC repayment. So we have done that from our existing cash balance, or we have generated enough cash flow in July and we have paid out from them. Just checking because so as to ensure that
First 100 crore we have paid out of the project cash flows, and the remaining 100 crore we have paid. We have taken a commercial paper of 100 crore, raised through money from commercial paper, and then we repaid to the IFC.
Got it. And that commercial paper, I assume, would be for a short term, 1 year, 2 year kind of
30 days maturity period, which we are paying them in August.
Okay, so yield must be around 5.5%.
Yeah.
Okay.
This project is sold very well, and collections have been extremely robust here. So that really gives us the strength to be able to quickly pay back and negotiate a good exit.
Yes. Got it. Thanks. That's it from my side, and all the best for full year 23.
Thank you.
Thank you. Next question is from the line of Neeraj from White Pine Investments. Please go ahead.
Yeah, I have a question on your launch pipeline. All the launches that you are planning in future will be launched by March 2023. Is that the right statement?
Will be launched by
March 2023. All the launch which is represented in the
16 million square foot. We are talking about launching in phases, starting from this current quarter to the next 2 quarters. Yes.
Q2, Q3, and Q4.
Yeah, Q2, Q3, and Q4. Correct.
Okay. The other thing is that you have a target to reach to 5 to 6 million square feet as a potential run rate of pre-sales over the period of 3 to 4 years. Is that also a right way to see?
Again, that is a question of the quantum of launches we do and how many phases we open. But I think the previous question or the previous discussion was more on the delivery, on how much volume you're looking at in terms of delivery, which is why I answered and I said, look, over next 3 to 4 years, you would start seeing about 5 to 6 million square foot per year of delivery versus, say, about 2.5, 3 million square foot that we have been doing traditionally. So you would double it up in terms of delivery. But of course, from launch to delivery, there is a journey of about 3 to 4 years, and that's the journey we need to cover over next 2 years. In the meanwhile, I think we need to really watch the, as I said earlier, sales numbers and the cash flows.
Okay. So how much land banking square feet do you require to go to that run rate of, say, assume let's do a 6 million square feet of pre-sales. How much land bank would you require on a run rate to achieve that pre-sales?
So typically, whatever you open or what is your open for inventory sale in a year, you typically sell about 50 to 60% of that, and then it starts lagging because the choice of inventory comes down, and then you add more inventory, and then you sell again 50 to 60% in the year. So that's the general cycle that it works. So whatever you open for sale of that, 50 to 60 million. So for example, traditionally when we have been doing about say 3 million square foot. Traditionally, we have had about 5 million open for sale at any point in time. So that is how the numbers move up.
No, I got it, but I was asking something else. I was asking on your land bank.
What about land bank? You asked for land bank.
Yeah. Okay. Right, you have total.
We are going to launch about 18 million square feet. That everything land is acquired and by the company, and it's a different stage of approval. And hence, to launch for next 3 quarters, since current quarter, next 2 quarters, entire land has been acquired and it's in our position in various stages of approval.
Yeah, got it. But the future land bank, apart from the new launches that you will do for 16 million square feet, you have as much as what I know is almost 65 million square feet of your interest.
So, sorry, 44. Remaining land bank. I got your question. So remaining out of my total land bank of which is we have land bank slide, we are proposing to launch about 18 million square feet over next 3 quarters, and remaining land bank also in different stage of clearances, approval, etc. And at the same time, like we informed in earlier calls, that we are continuously working on the business development, exploring new opportunities, and we keep adding in our land bank developable, sellable area.
And I'll just add parallelly to that, the balance area which is available is also under work, right? So we will see continuity of launches even in the next year because, as you rightly said, if there is over 50 million square foot of portfolio, that portfolio needs to be monetized. So if 16 million goes to market this year, of that, of course, in phases, Similarly, we are working on the next phase, which is going to come in the next year. And of course, the unopened phases of the current 16 million will also come to the market in the next year. So that it will continue to grow, on a cumulative basis.
So you're just on some numbers, like we have around 44 million square feet of land asset that you have given in the presentation. So that 16 million square feet is included in this 44?
Yes, you are right. Yes. Perfect. This is a subset of the land bank slide.
So you will have remaining 28 million square feet, which will be around 4 to 5 years of potential sales that you can do. Right.
Correct. Plus, you will add whatever we are adding now. We are already in acquisition mode, as the previous caller had asked.
Right.
So we will continue to add more and more inventory and land bank as we go along, which will also cumulatively add for, say, the year after next and then the year after that.
So what I was coming to is and you also have a entity which also is the AIF fund that you have started for buying land, which will feed to your development projects. So you have so much of land bank left. You have an AIF fund which will buy up land. So then why do you say that you want to see a reduction in your absolute debt, because you already have 5-6 years of existing land bank in existing big company? You have an AIF which can also do that. Plus, there are also operating cash flows for future projects coming, which can, say, partially feed to buy land. Then why do you, so I'm not able to understand, why do you say that the absolute debt shouldn't fall for the company?
Okay, on an absolute number, I think one needs to look at it slightly differently. There are 2 or 3 things. One is there is capital that is obviously churning constantly, wherein the debt is getting repaid, but fresh debt gets drawn down depending on the quantum of square footage on the floor for, say, for example, launches, or, for example, construction funding, CF, etc. Plus, more importantly, as we venture also in the commercial real estate piece, there will be debt drawn down for the commercial projects which are going to go under construction. For example, we have already undertaken about 8 lakh square foot of project which is in South Bangalore, which has already gone under construction. We intend to take another 2.1 million square foot of North Bangalore project into under construction. So, it is a constant process of churning capital and churning debt, and an overall basis. So that's what I say, when you look at it on a per square foot basis, obviously as you do more and more launches, the numbers will look very different. But as an absolute number, we have to continue to look at it from the basis of what is the quantum of the project that you're bringing on the floor.
Okay, got it. The last question will be, how much investment you have done in the commercial project till date?
Let me come back to you with that specific number on how much investment. I think we'll respond to that on a
offline. Yeah, offline. Respond to.
And how much cash flow would it throw, say, when it starts?
Oh, I think over time, see the total business we are looking at from the commercial business itself, as I mentioned earlier, is minimum, as this year itself, for example, as I said, 2.7 million is going to go into construction. And if 2.7 million goes into construction, of course, it's all yield dependent and sale value dependent on what kind of numbers you're looking at. But from within this number itself, you would easily assume that you would land up with at least a top line of somewhere between 2,500 crores to 2,600 crores. So, as we go along and add more and more projects, I think the numbers will keep evolving.
Right. And you thought of any early stage of creating some easy structure, or it's too early to think about it?
I'm sorry, early? No, I think it's a little early to think about it. I think for us, what is important is to keep our heads down and continue to build this business. And over a period of time, that strategy will evolve. Of course, as I mentioned earlier, we're looking at a partner, a platform level transaction there for the commercial business. So, we intend to, scale that business over time. But we will be patient. We will continue to put effort in that direction. I think what's important is the longer term vision as far as the commercial piece is concerned.
Got it. Thank you very much.
Thank you.
Thank you. The next question is from the line of Akshay from UBS Group. Please go ahead.
Hi, sir. Thank you for taking my question. So, sir, this quarter pre-sales is of rupees 513 crore, and in presentation you also give projected cash flow where you give value of inventory open for sale. If I calculate difference of this versus last quarter, it's 280 crore, while sales is of 513 crore. So, what explains this difference, sir?
Sorry to interrupt.
Get your question. This 513 crore we have sold out of value of unsold inventory of the last quarter.
Right. Right. So, which was 4,674 as per last presentation, and in this presentation, the value of inventory open for sale is 4,400 crore. So, it's a drop of 280 crore. So, what explains this?
Added phases. So, what happens is, So, what happens? Your question is right. The observation is right. But what
Sorry to interrupt you. Sir, before you go ahead, Akshay, can I request you to mute from your side?
Sure.
Yeah, that's better. There was a lot of disturbance in the background. So I'll answer it again. What typically happens is you replace what you have sold by releasing more inventory from the not open for sale inventory. So that is what will continue to show up. So while my sales numbers will show up, I'll keep opening stock because I cannot at any point in time, have lesser choices in my projects from the consumer's point of view. So it's very important to continue to open not open for sale inventory, which we don't count as new launches. So I think that's the difference.
And we added one project itself during the quarter and sold it. We added one project during the quarter, Southway.
That was in the Q4 of the previous year. In the Q4 of the previous year is when we sold out something. That was opened and closed in the same quarter.
Okay, understood, sir. So that explains the difference on launch pipeline also, which was 16.3 million last quarter and 15.3 million this quarter. Is this right?
So that
difference is coming from the inventory which is open, not open for sale in the inventory slide. The difference in the launch pipeline is coming because of the one project, Kadagane-Halli, which was there in the last slide. This slide it is not there because Kadagane-Halli land we wanted to develop earlier as a residential project. Now because of the demand or the traction of the commercial property, because front end of that land is a commercial project, and hence we have decided to develop that property. It's also a commercial project which is under planning stage. We'll put in that slide once the necessary plan approval will come.
So phase 1, which is what I was mentioning, where we are doing about 2.1 million square foot. This is in North Bangalore. The phase 1 is going under construction now. This will be part of the phase 2. So we moved this from residential to commercial, and that's the reason why we have removed it from the launch pipeline of residential.
Okay, understood, sir. And sir, I'm not sure if you have mentioned this before. I joined a late. What was the sequential pricing growth?
So overall, if you look at it, the sequential pricing growth was about between 6 to 8% on project basis, but average realization I think has not moved much because I think that more comes from the weighted average of the mix of inventory that gets sold. But on an overall basis, the prices went up between 6 and 8%.
Right. So is it fair to assume that value of inventory open for sale, this also goes for price adjustment which you have taken?
What is not open for sale and what is open for sale and unsold will go into that.
Right. Understood. Okay, sir. Thank you. That's all from my side.
Thank you. The next question is from the line of Ronald from Sharekhan. Please go ahead.
Yeah. Good afternoon, sir. I had just one question regarding deployment of capital through institutions like IFC. So, as our debt levels are at the levels, and you do not want to increase the debt levels going ahead. So we may see further investments coming from third parties in say residential or commercial, and you also provide them IRRs in the range of 20 to 30%. So my question is that how you are able to generate the IRRs, because does that dilute your returns from the projects? Also AIF you are committing at mid-20s returns. So not able to leverage the balance sheet and getting these funds with a fixed kind of IRR. So are we able to kind of generate returns from these projects?
So, I think let me answer this question in two parts. One is, it's never close to 30%. It's early 20s, and it is not a fixed IRR. It is dependent on the performance of the project. That is point number one. Point number two, I think, is when we have to look at our capital is obviously far more expensive than the 20% kind of IRR that we're looking at giving to these equity partners. The objective of diversifying your risk and taking equity instead of debt, I think comes from the fact that we want to be very, very mindful of the market conditions that obviously continue to go into cycles as we go along in the economic cycle. Therefore, the need for equity versus taking debt. I mean, I think there are a whole lot of analysts on the same call who asked me, will you take more debt for acquisition? So that's where this comes from. Now, as far as the debt per se is concerned, we don't have a problem with increasing our debt, but our whole focus really is how much business justifies how much debt you've got. That's how we look at it. So if your quantum of business on the floor and the volumes you are doing is going to justify more debt because you need construction funding or launch or pre-launch expenses, etc., then that is yes, that is no problem. That is justifiable and you will take it. But if for example, I'll give you another example. What happens is our equity which is there today in these projects, the surpluses which is there, which is sitting in this 50 million square foot, which is our equity as an organization, I will leverage that equity to add more equity to it, and therefore it multiplies my ability to do business. So that's how we look at multiplying our capital strength, and of course the kind of opportunities we are looking at is a mix of joint development as well as outright, where the IRR numbers are fairly different. And when we factor in the BD, we factor in the cost of this capital before we look at our margins, and then we look at our multiples on our equity invested, and therefore it looks much better, and therefore we are able to do a lot more volumes than what we do currently. But yes, would we want to do more business with our internal accruals? The answer is yes. And it will happen. And of course, a lot more of our internal accruals as they come along, we may prepay a lot of equity. Like for example, we have done that prepayment right now, and that has saved us money. Correct? IFC has been paid back earlier than planned, way earlier, from internal accruals. So we'll continue to engineer our capital to minimize our cost of capital, but at the same time, we will not compromise growth while we do this.
And to add to it, if you look at where we deployed this equity money, and even for AIF fund, we are planning to deploy this money to acquire the land. We are not planning to use this money for a construction finance. And hence, there is a risk. The number one is the risk. Number two is the availability of capital for a particular activity. Today, to acquire land, there is no construction finance available, and hence we are resorting to the equity funding as well as AIF funding, and we are not using this money for construction. As in wherever there is available construction finance available, we will take construction finance for a cheaper cost, and thereby it's a kind of trade-off. Where there is a risk more, I'll take equity funding, and where there is a pure construction finance, we'll go for a bank and get a cheaper finance. And overall, we will achieve a overall margin, the weighted average margin, best for the shareholders as well as the investor for the company. Right?
So just one follow-up that you are able to generate similar kind of returns you provide to the investors, or a bit less, or?
No, of course, our equity will be much higher. Our return on equity is obviously much higher than what the investor gets. Clearly.
Okay. Thank you very much. Thank you very much.
Thank you. The next question is from the line of Raj Shah from RS Investments. Please go ahead.
Hello.
Go ahead, sir. You're audible.
Thanks for the opportunity. I have some questions. What will be your marketing expense for the quarter as a percentage of sales? And given that the sector is on the uptake, can we assume that the marketing expense would be going up in the coming quarters? Hello?
Can you hear us? Hello?
Yes, now it's audible.
Sorry. So typically our marketing expense is between 5 and 6% of the sales value. But during many quarters where you are incurring pre-launch expenses, wherein the sales are not shown, but to prepare for the launch, you do marketing expenses. Those show up in the same quarter, wherein the revenues don't show up or the sales numbers show up only in the next quarter. So to that extent, yes, it may look higher in some cases in some quarters, but then in the follow-through quarters on an annualized basis, if you look at it, it should range around 5 to 6%.
Okay.
But that is different from what it is in terms of the revenue booking. So again, you need to keep that, you need to be mindful of that.
Correct. And just to follow up on your answer, we had a good quarterly sales numbers this time. However, our revenue recognition was not that strong, and because being a lag in delivery. So if you can just highlight, when can we see this improvement?
I think in the third and fourth quarter, we will see a sizable improvement because a lot of these projects are coming up for possession in those 2 quarters. So we'll start seeing improvement in the third and the fourth quarter.
Okay, thank you. And just one last question. If you can just give your mix, revenue mix, as in the revenues which are coming from Bangalore and outside Bangalore.
Would you want revenue or you want the sales number?
Sales mix.
Sales mix. So, currently over 50% of our sales is coming from the Bangalore market, and the rest is distributed in the other market, which is other regions, which include South and West. And in fact, more than 50%, almost 60%, close to 60% coming from the Bangalore market. This trend will continue for now. For some more time, we may see a larger contribution of the Bangalore market in times to come. Overall, South will also look a much larger number compared to West for some time till we don't start launching the projects that we are acquiring in the West.
Okay. Thank you for your detailed answer, and I wish you all the best.
Thank you. The next question is from the line of Mihir Desai from Desai Investments. Please go ahead.
Thank you for taking my question, sir. So I just wanted to ask regarding the AIF. So where are we actually planning to deploy this fund? Like in terms of category, that is, Puravankara, Provident, Purva land, or also if you can throw some light in terms of geographical locations, where are you planning to deploy this fund?
So good question. This fund is planned for Purva land and Provident. The idea is to turn the fund around as quickly as possible and return the capital. And we see both these businesses generating a faster return of capital. So that's the answer. And the deployment in terms of geography, of course, South remains one of our favorite markets. So yes, South will definitely be there, but we are adding projects in the West as well. So we are looking at some projects in the West as well. So it will be a mix of both South and West.
Okay. And so secondly, I just wanted to ask regarding the land bank. So if we see that currently we have a land bank of which is totaling somewhere around 57 million square feet, wherein Puravankara Group's interest would be somewhere around 44 million square feet. So can you please throw some light on where it is located and how are we planning to monetize it in coming?
So if you look at the numbers, it's mentioned in slide 8. Almost 38 million square foot is in Bangalore, which is why I keep saying Bangalore will continue to be dominant for some time. Then Chennai is about 6.8. We have Kochi and the West, which is mentioned in the slide 8. So if you look at that, that will give you a breakup.
Okay, sure, sir. And sir, lastly, I just wanted to ask that till last quarter, we had this Khadi Ganahalli project under Puravankara Bangalore schedule to be launched somewhere in Q2 FY23. So if we see this quarter, it has been removed from the launch pipeline. So is there any specific reason behind this?
Yeah, I think you missed I think this question was answered in the previous question. What we have done is we have shifted that piece from residential to commercial. Look, in the front portion, we are doing about 2.1 million square foot of commercial, which we are launching in the next quarter in terms of construction. So the kind of demand we are seeing in that market and the RFPs that are coming, we realize that it has great potential as a commercial asset, and hence we have moved it out of residential and decided to do it under commercial, and we have put those plans on hold. And therefore you see the change.
Sure, sir. I think I'm done with my questions. Thank you for answering my questions.
Thank you.
Thank you very much. I now hand the conference over to the management for closing comments.
Thank you once again, ladies and gentlemen, for your time and attention. I hope me and my colleagues were able to answer all your questions. However, if you require any further discussion, we are always available for the discussion during the coming weeks. Thank you, and wishing you a happy weekend and a very happy Independence Day. Jai Hind.
Thank you very much. On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.